Okay, SPY, and then just pick any date, June 18th. I think we went over June 18th yesterday, but I can go ahead and do it again. I think that was the easy one. Wait, where is it? Oh. Okay, same thing as we do every day. I open the chart at 8 a.m. and I'm going to mark what current trend we're in. Okay, so it looks like we're in a downtrend. It might keep breaking trend, but we're gonna wait to see what happens near market open. Okay, so right here, this is 822. We get a break right here, comes back in, and then we go into open. So this downtrend line is still good. It got broken in pre-market, but not in market. See, it came back down. So what we're waiting for is once price breaks this red downtrend line, that's when we're going to enter calls. And because if we don't have a uptrend line form yet, this red line will also be our stop loss. So say if price broke up something like this straight up with no uptrend line, if price were to cross back in, that's when we get out. So if you enter here and exit here, it's not that much of a loss. It's only a couple cents. And it should happen pretty quickly if that's what's going to happen. All right, let's let this play. Okay, so right here, this is where you would enter calls. The way that I play my entries is that if I start to see a big move, I will just market order in. So I'm paying attention to 3 or 4 charts, but when I see price get very close to breaking a trend line, I'll go to that ticker, pull up a market order for something uh, pricing in the range that I usually play, and as soon as price breaks above, I hit buy. Okay, so we'd enter here at 598.38. Okay, our entry here is 598.38, and we're in calls. Okay, and before it broke the uptrend line, we had enough time to draw this uptrend, and we always color our uptrend lines green. So now that we have the uptrend line formed and price crossed and broke the downtrend line, as long as price stays above this green line, we're going to stay in this trade. So if we get a candle close below this green line, we would exit, unless there's a fair value gap, and I'll show you that if that happens. Okay, so if you guys don't have this indicator, I highly suggest you download it. It's FEG by Nephew Sam. Okay, so what this is going to do is chart out these fair value gaps in real time for me. And when they get invalidated, it's going to be the same way as the trend line. If if you see a green box, that means that every time price touches it or comes into it, you should expect price to bounce out. If it closes below the threshold of the green box, then it would invalidate the fair value gap and it's going to disappear from the screen. So once that happens, this area is no longer an area of support, right? So you see how price, we have a bearish fair value gap. It's in red. Every time price touches it, it should come back down. So we came up here. This is resistance, hit it, came back down. And we did break the green uptrend line, but you see here that we have a fair value gap right at the line. So in my strategy, the way that I trade it is if there's a fair value gap right at the line and price does not invalidate it, then I can continue in the play when price comes back up above the uptrend line. You see that price came in here with this wick, but didn't close. If it closed below the last, area of green, then it would invalidate this, and that's when you would exit this trade. That's the way that I trade it. Strictly going by like the original way is that you would have exited on this tip of this black candle because it closed below the line. Does everybody understand that? Put a one in the chat if you're still following. Okay, great. So I'm going to move on. So when we get this fair value gap right here and we see price bounce into it and come back up, what we have to do is we're going to have to move our trend line over now because this entire move is encompassed in the same, trend. So we want to track the actual trend that's happening. Okay, so now we shifted it over. As long as price stays below where the green line is now, that's where we're going to stay in the trade. So we're getting fair value gaps. You can look up how they're formed, but it's pretty easy to draw yourself. You don't actually need an indicator like this. Okay, so right here, we get areas of support built up all the way on the move up. We're getting bounces. And then right here, you see how we get this candle wick and then the candle closed above? This would keep you in the trade still. All right, so that's an important thing to know is that as long as price is only wicking, then you don't have to worry about getting out of the trade. But once that price closes below this green line without a fair value gap nearby, then you should probably exit because that would start the next downtrend move. Just based on probability, it's not guaranteed. That's why you're gonna have to backtest and see how often that happens to make your decision on how you trade. These exits. But I'm teaching you the way that I do it. All right, so we're still in this trade, and we're going to go ahead and move our trend line over now that we've bounced there. Okay, so we're moving this over. As long as price stays below, it's the same thing. Or as long as price stays above, we stay in the trade. Okay, so this is where we get our close. And we can actually check to see, there was no fair value gap right here. So when this candle closed, this is when you should have exited, which is at 676. Okay, so you would have entered these calls right at around 8:47 and exited at about an hour later. So you would have gotten about 100, sorry, what is this, $2.40. This is definitely like a 2x trade right here. And what I tell everybody is that most of your, like the biggest trends that you're going to find are right around open. So around 8:30 to 10, this is like your sweet zone that you're going to find that trend. And you realistically only need one of these trends a day. Okay, so whatever you make from this, and then I usually take the money that I make from the first trade and I start practicing on scalping smaller trends. And so I'll show you here. Most stock tickers, once you get this big move, that's pretty much it for the day. But sometimes you'll get a stock that has like one or two moves. I think Palantir today, if I'm not mistaken, had 3 to 4 moves. Like we had one move up, one move down, up, down. As long as you're catching it at the right time, you can catch this entire trend like we did here. So you're exiting pretty close to the top. All right, is everybody following that? Okay, we're just gonna go ahead and move on to marking now. If you were not in these calls the entire time, then your next step would have been to look for a break of this uptrend line so that you could enter puts. So if you weren't in this trade yet, you would have entered puts right here at 696, or what was it, 697? No, 697. Okay, so we don't really have a downtrend line formed yet. You can draw something out just so you can see it. These lines are give you like a visual representation of your stop loss, so you can have a better idea of where you are in the chart relative to everything else. See, this is not really even a downtrend yet. So we enter here. If you don't have a downtrend line formed yet, you're going to enter blindly using the green line as a stop loss. So you see this is sloping up. It's really risky to do something like this. So actually, what I would do is just, if you do decide to enter, just go ahead and put a horizontal stop loss. So you're going to do it at the high of the wick. So what this is saying is that when you enter here, as long as price doesn't break this high, then you're going to stay in the straight. It's a little bit safer than using this green line because this green line is sloping up too high. Okay, let's let this run. Okay, so right here we have our next swing high, so we can go ahead and draw our downtrend line. And go ahead and get rid of that. Okay, so now that we have our stop loss line in place, as long as price respects this line, we're going to stay in the trade. If not, we're going to exit right away. And so the way that you do that is when I first enter a trade, say we're going to like 697, so I would do probably 600 puts here. I would enter it and then immediately set a 25 to 50% stop loss. I don't expect price to actually hit the stop loss, but say like we get a news candle or Trump says something, tweets something, and you get the big wick. That's going to prevent you from blowing up that trade, right? But most times you're going to actually manually stop yourself off. So after you set that stop loss, go ahead and switch your screen to a market order, um, and execute on the market because as soon as you get that candle closed, you need to be out of the trade. All right, so we're gonna go ahead and stay in this trade as long as it respects this downtrend line. Okay, so we got a candle wick here, no close. Okay, and then we got our close here. So right here, this is where we would have got stopped out, and you would have manually stopped yourself out here. So entry was up here at 697. And your exit was the candle close 614. So this is not as big of a move as this, but this is basically the pullback. You're able to time the pullback almost exactly and catch the reversal for a continuation upwards. Can everyone see that? Put a one in the chat if you're still following. Okay, let's see. Loop, there he is, asked, are you waiting for a candle close above / below the trend line to enter? Okay, so you should be waiting for a candle close to enter. That's the original way the strategy is meant to be played. But on my entries, I front run my entries. So as soon as I get like a move up and it looks like I believe it's going to continue up, I'm going to go ahead and enter. Right. So say we're over here and we get this big move down immediately, right? If you don't enter here right at the break and you enter down here, your stop loss is way more than if had you entered here. Right? It's always best to enter as close to the line as possible. That way that if you get like if it's a fake out, then you'll know immediately. Right? You enter here at 697. Like let's say next candle it pulls back up, pulling back in would be at 601.03. So that's like 6 or 7 cents on SPY, which is like almost break even on the option. Right? So on entries, I front run mine. You're just going to learn that what to do when you don't have the reversal trend line set yet. So here, because we don't have an actual, like if it was like this, then I would use this as my down trend line, but it was almost going up, right? So then at that point I would do this. I would just pick the highest wick, and as long as price doesn't break above the highest wick, then I would stay in the trade. Right? These lines are just so you can have an idea of where you are in the chart and just be able to visually see it. Because if you didn't have any of this, like I remember when I was trading like this, and I would literally just look at the chart and be like, oh, it looks like it's gone up high enough. Let me go ahead and start buying puts here. Right? And I'm sure a lot of people who just get into trading, like that's literally what you're doing. You're looking at the chart and seeing like from down here 597 and you see it gets up to 599 and you're like, that's a big move. It should pull back any second now. But you see, we didn't really pull back until way up here. Right? So trend lines are a way for you to visualize market action. Okay, so we go ahead and deleted that. If you entered puts here at 697 and you exit here at 614, and at this point, if you were not playing the puts this whole time, you would have entered calls here. And I don't suggest you try to switch right away because your entry and exit sometimes are not going to be at the right place or at the same place. Because on your exits, it's a candle close, and on your entries, it's right at the line. Right? So people who weren't in the calls or weren't in the puts the whole time, they have a better advantage of entering right at the line. Okay, so if you weren't in puts this whole time, you were waiting for calls, you would have entered right here at 613. Okay, and then we do have this uptrend line that's forming here. But the thing about using a line like this is that price is hugging so close to it that any little pullback on the very next candle, just because it forms on the next candle, it moves over one space, right? And it's so much easier to wick out or candle close out of this. So what I like to do is I'll mark the uptrend line, but I'm not going to use it. It's just for me to see that price is moving up really fast. What I'm going to do is as long as price stays above my entry, somewhere here, I'm waiting for price to do a higher low, a swing low, so then I can draw this uptrend line. Okay. And then just looking at this chart, the way that I would look at this chart is that I see this big old fair value gap here. I know that as soon as price hits here, I should get a reaction and a sort of pullback. So that's where I'm going to mark my line. I know that it's going to form. All right. Okay, so we did get this reaction and we broke out of this line. So because we had this line drawn out and we saw this moving pretty quickly, that's what you would have exited. Right? We didn't get the swing low that we thought we were going to get because it came all the way down and actually broke this low. Right? Okay, so entry there was 613, exit was candle close about 636. So this, even though we didn't get a big move like we did over here, this is still a win, right? Anytime you close a trade green or you close a trade at break even and didn't experience a catastrophic loss, I would count that as a win. Right? If you didn't have this line and you entered here at 613 and it gets to 652 and you don't see anything on the chart, you don't know that this move is about to come. Right? These trend lines are basically to protect you from trying to gamble. You are taking risk, but these are calculated risks that you're taking. You're calculating that if price breaks this, then there's a high probability that it's going to go down. So you take that chance and you sell exit here. Okay. I think I can go ahead and move on from this ticker. You're pretty much going to do the same thing. Every time it breaks uptrend, you start marking the downtrend. Every time it breaks downtrend, you start marking the uptrend. And you're going to do that all day long. This is basically what day trading is, right? Swing trading is where you buy one day and you just hold. It doesn't matter. It's going to do this all day long. You just hold all through it because you think that in 1 week it's going to be higher. None of this matters, right? But in day trading, every single tick matters. Every minute that goes by that you're in the trade matters. So the purpose of this trend line strategy is to try to keep you in the trade for as long as you actually need to be. Okay, North has a question. How did you now? How did you know to get out of those calls that early if you were waiting for a new swing low? Okay, so we're doing this in replay function, and these candles are moving 3 times faster than they would in real time, right? I said that I wasn't going to use this line because normally we do get that swing low, but see after we okay, now I know what you mean. I would not have exited here. I would have exited somewhere over here because I was waiting for the swing low to form a rejection of this fair value gap and maybe come back down here, bounce somewhere here, and then come back up to draw that line. But we're moving so fast that I would have sold. I have my market order ready. When I start to see this move, I'm exiting. So as long as, and remember, I have this line also marked out. So this is going to be our break even point on SPY. Yeah. So in practice, I would have exited here. But if you kept this line here because you didn't have that uptrend line form and you were expecting that swing low, then this right here would have been your stop loss. Pretty much right at entry of where you entered. Okay. All right. So I think we can move on to the next ticker if somebody else wants to go. Let me pick somebody at random. Um, how about Lineman? Lineman, are you still in here? Oh, Lyman, you asked earlier if you have multiple contracts, do you have any predefined trims or do you use figs? Good question. So the only time that I have multiple contracts, meaning more than two, is when I'm highly confident in the play. And if I'm highly confident in the play, if I'm starting to make big moves, where I would start trimming is at fair value gaps. Right. So let's see. Let's say I don't know how this chart played out, but let's say we're inputs here. So we enter here, we draw our line, and price respected it, so we're still in the trade, and we have, let's say, 4 contracts. At 4 contracts, we're already pretty good in the money. We're profiting pretty well, right? And so this is a level that I would trim at, the first fair value gap that we hit, right? So just depending on your risk tolerance, I would probably trim half at least, right? And I know that I can see these fair value gaps. These lines are already drawn from on this move up. They bullish fair value gaps form on the uptrend move up, right? So I can see these already. So this would be my first trim, second trim, right? And then basically if you get down here, I'm selling the whole position. But that would be like if this was a really fast move down. When you get these big drops or even like a big move up, you should expect that pullback, right? So if you were in calls here and you get zoom, this move up, I would have already sold here, right? This was at 600. This was probably a key level. I would have just sold immediately because I know that somewhere along this, we're going to get a pullback. And if you're entering here and selling here, you're already green. It doesn't, like with this strategy, you cannot think that you left money on the table. You cannot let that be a decision to factor in your next trade. Every single trade you take, every break of trend is a brand new trade, right? You're looking at a new set of data. You don't care about what happened 5 minutes ago, right? All you're focused on is breaks this red line, stay in above this green line. I don't care if price was up, down, bearish, sideways. As long as this is the trend, this is what you play. Okay. Dragonfly asks, Steven, do you ever do 5 minute trading? Why or why not? Personally, I just don't do 5 minute trading because you're not going to be able to see every single move. So I've been trading for 7 years and I've done the 1 minute probably 4 years. I'm used to seeing these crazy wicks up and down, up and down, up and down. Right. So I'm just used to it. But on a 5 minute candle, you might not be able to see the reversal when it happens. At least on the 1 minute, and even if you play down to the 1 second, you'd be able to see the exact point that it reverses. Okay. Lyman, do you want to pick a random ticker and date? Oh, does anyone else have any other questions before I move on? Okay, Microsoft today. See, I don't trade Microsoft. The last time I had key levels for Microsoft was all the way down at 459 and 462. So I do not trade the stock at all. Dragonfly asked, does that suggest that the price respects the trend lines less at higher time frames? Um, no. So if you have a higher time frame, like say a lot of my lines that are not 1 minute are on the 24-hour trend line. Let me pull an example for you. Let's just say that's not a really good chart. Okay, this one's good. Okay, so these are 24-hour trend lines. And you see right here on June 25th. No, this is July 7th. Okay, July 7th. I have this trend line snapped directly onto this wick, right? Okay, and then if we drop down to July 7th, the July 7th candle showed that price respected the trend line right at the trend line and reversed, right? Or I think that's what we saw, right? But as you can see, what it actually did was it did all this chopping into this trend line, right? So on the higher time frame, we weren't able to see all of the nuanced movements. The fact that it reversed here at 139.21, right? Do you understand that? Because when we're day trading, we want to enter at the best possible price because it's a short-term trade. If price never gets back up to 139.16 in the same day, you will never make more money than this highest point. So it's very important what your entry is and what your exits are. Because the moment price, reverses on you and never revisits that, then the entire day your trade is just going to keep going down and down and down. You will never get back to green. So yeah, I guess I'm trying to see whether this strategy makes most sense for which time frame. So that honestly, that's just going to be backtesting. Backtesting is like when a chef sharpens his knife. That's the only way you're going to get better and have more confidence in your setups. Because I see a lot of you guys ask me like, what will happen in this scenario? What will happen in that scenario? My best advice is go and look for that scenario and see what happened. See if you can replay and predict that was what's going to happen, because that's what I do in chat is when I'm giving commentary, I'm telling you that what's most likely going to happen based on the probabilities that I saw in my experience. Okay, so we're going to go ahead and go back to Microsoft now. Yes, north is correct. Even with using the same strategy, there's people that only do it on the daily. Like they only swing on the daily. I trade everything on the 1 minute. but you can easily go to the 24-hour or the 1 hour or the 4 hour. Just make sure that whatever time frame that you're using for confirmation to enter the trade is the same time frame you use to exit. All right. Okay, so we start here. I went a little too far back. Oh wait, no, this is. Okay, so we're here at 7:30. I'm gonna go ahead and mark out the trend that we're currently in. Okay, we're in a downtrend here. And we're gonna see what happens, whether it respects it or continues into open. Okay, right here, right before open, we got to drop into the downtrend line, and then you see at, let's see, this is 8:30, right? Right at open here, it broke the candle right here, right? So if you want it to be risky, you can enter calls right at open with a stop loss below this red line. I don't understand the premium pricing action on how price on options move for Microsoft. So if somebody knows like how much this, a loss this would have been, if you entered here at 546 and exited $1 lower, does anybody know how much that would be? I don't know, but on SPY, like something like this would have been like a couple cents, right? So this is a risk that you can take. If like price opened all the way up here, then no, I would not use, this red line. I wouldn't enter the trade. I wouldn't chase it. I would wait for a pullback at least, right? Because as long as price is above this red line and not breaking its own uptrend line, then you should expect price to be continue going up. The reason why we don't chase and we try to enter right at the break is because this is the possible best risk reward. Okay, so let's let this continue playing out. Right here, we're going to be looking for a swing low, and so we pretty much get one right here. Just to be safe, we're going to go ahead and draw this out. As long as price is respecting this green line, then we're going to stay in these calls. And you get a break here, so you get it stopped out here. Entry was 542, somewhere in here. And the exit was 501.78, right? So you're not, you didn't catch the biggest trend of the day, but it's not a loss and you got something out of it, right? So now that you see that price is breaking and it's about to break this high, we're going to go ahead and move our trend line over because this is um, part of the same move. Once you've exited those calls, if you were confident in your play, the way that you can also use trend lines for continuation is that, like I said, the best possible place to buy anywhere is right at the line. Why? Because you know that if you buy here, let's say price comes back down and tests this here, you know that if it goes and does something like this, you are immediately out of the trade. You know that the trade is dead. And that's like a few cent loss, right? You're losing less than 5% on this trade if you market order immediately out of it. Versus if price bounces from here and does something like this, and you buy right here. Let's say you buy right here. Price pulls back a little bit, makes a new high, and then boom, comes down. Your stop loss now is right here. This is where you would have exited and you would have lost all of this money. Versus if you had entered right at the line and you would exit at the line. Or if it did like this, you're exiting in profit still. Okay? Does everyone understand the continuation aspect of trend lines? Please put a 1 in the chat if you're still following. Okay, great. And then I'm gonna go for maybe another 20 minutes. I'm gonna finish this chart all the way to probably 10 or 11, and then I'm gonna open the floor to questions on anything about trading. If I can answer it, I'll answer it. Okay, so here, yes, you would have had to exit this trade because our our stop loss is always a candle close below this line, right? One thing I did say though is that if we had a fair value gap at the line, then that's something that could have kept you in the trade. Like let's say we had a fair value gap from back here, like that, right? This would have allowed you to stay in the trade because you know that this is exists, that it's here, and that when price comes into here, it should more often than not bounce, right? I say more often than not, I would put it at probably like 51%. It's still 50-50, okay? But it's more of a chance that it's going to bounce out of it. So knowing that, your stop loss could then become, instead of a stop loss of a candle close that was like right here at 501.76, your stop loss would have then been, oh, where's my tools? 501.61, right? So this 9 cents would have kept you in the trade. That's why sometimes you get, you think you're going up and then you get like a pullback and then you exit because you don't know how far is too far for the pullback. Okay, so once you've exited this, I do not recommend you going into the very next, uh, the reversal, because you're exiting where lower than people who weren't in the calls, right? The people who weren't in the calls, they're entering somewhere up here like 501.98. Your Once you've exited the trade and you try to enter the puts, your entry is way lower than them. And then your stop loss again, let's just say for example's sake, this is your downtrend line. If you enter here, your stop loss is, here. But if you're entering down here, your stop loss is gonna, when the price is moving, stop loss is gonna be over here. So once you've exited the trade, I do not ever recommend you going into the reversal trade immediately. Just find another ticker. All right. That's why I chart probably like in the morning I chart 6 to 8 tickers to find the first reversal and take that. And then all throughout the day I'm spreading out my attention on 3 to 4 tickers. Once I exit one trade, I'm looking at the next one. What's the next one closest to break? Okay, so here, because we're getting this move up still, I mean, yes, if you were to enter puts here, you would have got stopped out almost immediately. So I'm not going to go into that. We're going to try to find the actual reversal. So the actual reversal is going to come when we actually, make break trend and don't make a new high, right? Because this broke trend, but then it made a new high. So we're going to move this over. This is still part of the same move up. Once we get a break to this line now, this is when we're going to enter puts. Okay, right here, see that? We got a fair value gap right at the line. When price is starting to break and then it comes down and closes up here, you're the idea is that because price bounced here, it's going to continue up. So even though it closed outside of it, the likelihood is that it's going to continue up. Everything should be based on probability. Okay, but then once we got this close here, there is no fair value gap. This is when you should have exited, right? So if you stayed in the calls the entire time, this is where you would have exited. And then when we got this candle wick down here, we would have moved this line over. And then this is where you would have entered puts and then got stopped out. Okay, you would have entered puts here at 501.70, stopped out like 504.93. That's like 23 cents. I'm not sure how much that is in option pricing, but I can't imagine that's much. Right, okay, so we got this next Does everyone follow that part? How we keep moving the trend line over, and if you're trying to find puts but you get faked out, you're not going to be losing much as long as you respect your stop loss. If you didn't respect your stop loss on any of these trades, you see if you held on to those puts thinking it's going to turn back at any moment, look, you've already lost your pants on this trade. It's always been best to exit immediately and wait for the next move. I think the most I've gone through was like 3 fake outs today, and then I finally eventually caught the biggest move. Like this morning, I lost 20 cents on Tesla, and then the very next trade, because it was a fake out, I got faked out for 20 cents. Next trade was 87 cents. That was profit. So you're going to get faked out a lot, especially if you're looking for a reversal on a really strong trend. But the thing is, on when you get a trend that has multiple touches at the line, and it's long, like maybe a few more, like 2 or 3 hours long, you know that when price breaks that trend, it had to do a lot to break it. Like for it to keep bouncing off of it, it doesn't want to break it. But the second it breaks it, you know that it's most likely going to continue down. So what we're doing is we're looking for the real reversal here. Okay, so you got stopped out on this one for a fake out. You move it over again. See that? So once we got this right here, we came back in and we immediately gap down right here. This is where I'm entering puts. Entering puts here at, and this is a gap down. Usually you will see like the next candle close be very close to the next one, but you see there's a huge gap. Okay, so this is a entry. For puts, we're at 505.98. And we do have a very flattish downtrend line, but we're going to use this one for our stop loss. So I can explain another day when I know when to scalp and when to not. But if you were to scalp, this is a really big move in a very short amount of time. And so this is when you would be wanting to sell at fair value gaps. Like I said, fair value, I explained earlier, fair value gaps are, when they're green, this is where you expect areas to bounce. So if you're way up here and you get a sharp move down, you should expect price to hit this and immediately pull up. And it's going to hit one of these key levels, right? These resistance zones, these bearish fair value gaps. And if price wants to continue lower, what it's going to do is go in here, grab a bunch of sell orders and push down. And so basically it's a struggle. Buy orders here, push it up, sell orders here, push it down. Whichever wins out is the direction we're moving. Put a 1 in the chat if you understand that. Okay, so these two things are tools are the only things I use for my strategy is fair value gaps and lines. And technically fair value gaps are lines. It's just this. Fair value gaps are the space between the candle wicks of a 3 candle pattern. From the bottom of the first candle to the top of the second candle, the wicks. That's what the fair value gap is. What it means is that price was selling so fast that there was a bunch of people that wanted to sell and they just missed their opportunity. So what the rationale behind these fair value gaps is that when price comes up to test this area again, the people that were holding the stock that wanted to sell, they're immediately going to sell because they told themselves, okay, I missed it. If it comes back up, I'm selling immediately. And so what we expect is for price to come up here and get rejected. All right, let's let this play out. Okay, right here we have our swing right here. So we can do something like this. And then when price comes up here, we should get stopped out. But like I said, we have a fair value gap here, right? So when price comes up here, it should reject. So even if we get a close up here, we know that as long as price is respecting this fair value gap, then most likely it will continue downward and we can draw a new downtrend that we can form, right? So you're going to have to understand when to respect the candle close and when you don't have to. Right here you have a fair value gap and it's trading into it, so we should expect that rejection. Whether it happens here or if it came up here and did this and then came down. But you see, as long as price respects this level right here, then we should expect price to continue down. And from here, let's say you didn't sell here 504.51, 504.76. That's like a 25-cent difference. If you can stomach this drawdown or pullback, then go ahead and use the fair value gap if it's right there. Okay. So I'm going to draw it out just so you guys can see that how it plays out both ways. So this is the trailing your trend line down way. This is the most conservative way, is to try to hug the line as close to price. And if it works in your favor and gets rejected, then cool, you stay in the trade. If not, you just take your wins. Okay, because we entered at 505.98 and we're right now at 504.36. Okay, so let's let this play out. Okay, so you guys see what I mean? I've never seen this chart. I don't trade Microsoft. I just know that a lot of people get faked out here on this move. Right? We're still in the fair value gap. We do expect the rejection and we get the rejection. So what happens here is when we get this drop here, we immediately move our line over and now this is our new trailing trend line. See, we're hugging it close to the price still while still being in the trade and not gambling or, taking a big risk. We only risked a 25-cent move to get this further downside. Put a 1 if you understand that part, that we really only risked another 25 cents on Microsoft. Okay, so that's the very important thing, is you should always understand the risk of where you are right now in this trade. Like if I let it run for a little bit more, how much would I potentially lose? And where is it going to bounce? Because if it doesn't bounce at where I think it's going to, then I need to go ahead and just exit the trade. Okay, because if you held, say you didn't want to respect this line and price comes up to here, and then you have this fair value gap here, and you think, okay, well, now I'm going to play this fair value gap as my stop loss instead because it worked down here for a little bit, right? And then price ends up going here. Instead of selling even at 504.74, now you're selling at 505.88. And you're going to take the loss because you're right at your entry, almost 30 minutes later. So this would be a losing trade. Okay, so sometimes it's best to just take profits. You got to understand your market conditions, whether it's scalping time or not, or whether it's the time you can ride the trend. Okay, so based on this new trend line and following this fair value gap, we are still in this trade. Here's some more levels you can trim at. Anytime you get a fair value gap, you should expect to bounce, so good areas to trim. So if you have 10 cons, maybe trim 2 or 1 at a time. If you have 4, you trim 1 at a time. All right, we're gonna let this play out. Okay, here we do get the candle close. Oh, we don't get, okay, one thing I gotta show you guys. This is pretty much just a wick. This is not a candle close. This, on a black candle, this is where price opened. Okay, so sometimes I see people get confused and they're like, well, I see this candle closed out here. No, this is the candle close, the green. This is the candle open. This is the candle close down here. Okay, please put a 1 in the chat if you understood that, because that's a question I get a lot. Okay, great, North. Yeah. Yeah, some people forget that on a green candle, the bottom, or up candle, the bottom is the open, the top is the close. On a downward candle or black, top is open, bottom is close. Okay, so this is not stopping you out. Okay, but this wick, we do need to adjust it over. Oh, okay, yeah. No, it's not because it has to be the close. Okay, but if it opened outside and started moving the other direction, go ahead and exit. That's just price action telling you like you're in the middle of the candle, you should know to get out. Even if it were to pull back, more often than not, if you get a break and movement up, chances are it's going to continue up to a point where you're going to get stop loss anyways at a percentage loss. Okay, so we are still in the trade. Our entry, I'm going to go ahead and drag this down, was 505.98, and we're currently at 502.69. So you were deep in the money. You should not be in full position sizing down here. Maybe you have your couple runners left, right? When you're down to your one or two runners left and you are, it's free money, you can start being a little bit more risky, right? This is a very conservative trailing downtrend line. We're constantly moving it over to adjust, right? But if you were like down to your one or two runners and all of this is free money, you go ahead and delete this line, right? And just ride it as long as you think you can. Maybe set um, maybe set stop losses at highs. Like as long as it doesn't break this high and continues in making lower highs, you stay in the trade. Okay, but let's go ahead and go back to the way we had it because that's the way I would trade it. I would never use this line, right? Because that's just too far out. All right, so as long as price is staying under this red line, we're going to stay on the trade on our runners. And then boom, we are exiting here. I don't care if it continues to make this move down. The fact that you wrote it from 505.98 all the way down to 502.14 on runners, like you should be up pretty good. I don't know option pricing, but pretty sure you should be good. Okay, so that's right there. That's two trades you could have taken. Oh, one trade here, and then if you weren't in the calls, then you could have taken the puts. So there was two opportunities to make like decent, meaningful money on Microsoft. Okay, so if you weren't in the puts, every single because I front run the calls, I would have gotten faked out on all these little wicks, right? But I would have exited immediately, and so none of these are. You would have got what was it, one, two, three? You would have gotten faked out three times on the way down to enter calls. But because we're making a lower low, we're going to go ahead and adjust this line over to try to find the real reversal. And trend lines, you will eventually find the almost exact reversal point from top to bottom or bottom to top. Okay, right here is when I would have entered calls. Okay, and we don't have a proper stop loss line yet, so our stop loss is going to be either right at the entry or use the red line, whichever one. You don't actually have to draw it out or anything. You just have to have, make a mental note in your head. Could you possibly show which instrument you use to draw the trend lines for it to be? Okay, I'm sorry. Okay, so for trend line drawing, there's two options you could use. Okay, the one that I use in live trading is called Ray. It looks like this. Two circles with a line through it. And what that does is it extends the line out because I need the line to continue going and it's easier for me to adjust it in real time. Right? In my back testing, I use the actual trend line right here because I can control, how far I take it. And that's important when you're backtesting because you can see the entire move. So you know that this move right here all stopped right here. And it's just a little cleaner. And then for it to snap onto the wicks, you're gonna go over here to magnet and choose weak. Okay. The reason why you choose weak is that when you activate the tool, as you're moving, it's snapping onto the wicks. You can't tell, but if you're actually doing it, it's kind of delayed. And if you had it on strong, I mean, it's going to snap to every single little thing. So with Ray, you're if you're getting like really choppy price action and like um, say you're not really good with charting trend lines and you're charting every single move, it would look like this. That's when you get the laser show. Sometimes that is the proper way to draw it because you're getting deep moves. But when it's like little shallow moves like this, that usually means it's part of one bigger um, trend move. So that's why I always tell people to sometimes zoom out, literally zoom out, so that you can properly see the move. Okay, so I think we were somewhere like right here, right? Go ahead and delete this. Okay, let me get through this real quick. Um, if you weren't in puts here, you would have entered calls right here on this candle. That's 501.09, and let's go ahead and play that out real quick. See if there was one more move on this. No, it would have got stopped out because we got this trend line eventually formed. Entry was 501.09, exit was 501.78. So see, you don't always, even on these like little small fail trades that you think are fails, you're still exiting green. Like when you see my profit, sometimes I'll post my profit and you'll see like $1 here, $3 here. I'm not literally entering the trade and selling it for $1. I'm following the trend line, and sometimes it just stops me out a little bit higher than where I entered. And so I would still consider those as wins because I didn't enter blindly and hold through a drawdown. Okay, so I think we're pretty good on Microsoft here. You had both moves that happened. The calls were a little bit more risky because the break happened in pre-market. Pre-market right here, like literally 2 minutes before open. But you definitely should have been able to catch this move here. Um, Here, most people would have probably sold here. This is a resistance level or any of the fair value gaps. But as long as you're selling puts lower than you bought them, I mean you're winning. And once you start backtesting, you're gonna see these patterns happening on every single ticker, like literally all day long. I can't call out every single setup, but the high confident ones I call out in chat. Okay, so last 10 to 15 minutes here, I'm going to open up the floor to questions, and you can literally ask me anything. And if I have the answer for you, um, I'm going to open it up first to let's go with somebody who's not a member. Um, let me see. I guess Rafaelos. Okay. What was your first question? Okay, the magnetic, and then when doing live trades, do you only use 15, 10, or 1 minute to draw lines? I only use the 1 minute to day trade. So if my plan is to enter a trade and exit that same day, I'm only using the 1 minute. If I'm doing like let's see, what's something that uh, let's check Lululemon. Okay, when I'm doing a swing, I'm going to the 24-hour because I want to see what are historical levels that prices bounce from, right? And so here's something I would do for Lululemon. I go to the 24-hour and I mark out, let's go ahead and delete all this. First of all, I mark out my downtrend. The 24-hour will tell me overall which way are we headed, up or down. Right. Next thing I do is I go and zoom all the way to the left and I look at for where price has bounced from. You see these candle wicks that come down, or these lines, these sharp lines that come down, and all of a sudden it reverses like this. Well, if you find enough of these points bouncing at the same level, that's a huge reversal point. So what I found was this little box right here. this little box right here, and I found this downtrend line. So as long as price is staying below this 24-hour downtrend line, then you can expect the price to continue moving down, right? And then you get this box here. When price comes in here, you expect price to bounce, right? So when I have this drawn out and I see that there's a possible entry down here, what I do is I drop down to the 1 hour. 1 hour, and I try to find that spot, right? And then I drop down to the 1 minute. Once I'm down at the 1 minute, the only purpose of the 1 minute is to try to find the best position possible for that day, right? Because you're not planning to sell it right away, right? You're just trying to find the best place to buy it for that day. But at first I drop to the 1 hour to make sure that like the overall that we're going to bounce here. And then once I find that we're going to bounce here, I go to the 1 minute and just try to find the best place there. Because price is going to continue going up and down, up and down, up and down for probably days, right? And then you suddenly get that move. Okay. Penny stock said, North said, penny stocks might not have the liquidity to get quick exits when you get faked out. Yes, so that's why you really do want a stock with high liquidity because the spreads matter too. Like on SPY, the spread is only, I think, 1 cent between bid and ask. So as soon as you market order, you're not going to lose a lot of money, right? But like on, say, like Tesla, the reason why I lost 20 cents is it would normally be like 4 cents, but because the spread is always 5 cents, you get you lose a lot more. Question from Dragonfly. If you are getting stopped out quickly, can you lose a lot in fees for the option or trading fees? Okay, so if you're getting stopped, it depends on what your broker is. Some brokers they have free option trading. I use Thinkorswim and it charges 65 cents for each option trade. I negotiated mine down to 45 cents, right? So what that means is that if your option fee is 65 cents, it costs you $1.30. Costs you a dollar and 30 cents a trade. That's 65 cents for buying the option, 65 cents for selling the option, and that's per contract, right? And so if you're selling for a break even, you are going to lose $1.30 for every single option, right? If you're selling for 1 cent, you're losing 30 cents, right? So it just depends on your option fees. Some people, if you have free trading, I think Webull or Robinhood, one of those two has that, then you don't ever have to worry about selling for break even. Okay. Does anyone else have any other questions about anything related to trading? Okay, how about this? Put a one in the chat if you do not have a question. Or no, if you do have a question. Okay, well, thank you guys for coming tonight. I'm sorry we got a rocky start. My dog was outside fake throwing up. I don't know if anybody else's dog does that, but mine does that anytime he wants attention. He will sit there and start gagging. So I had to tend to that. But in the going in the future, I'm going to try to be more organized. This is my second workshop, and I thank you guys for your patience and asking very helpful questions. This is going to be uploaded to YouTube hopefully tonight. So if you need to watch it over again because you missed something, then it will be up there. And I added the chat this time so you guys can follow along when I'm responding to people. Hopefully that was helpful. Okay, well if that's it, thank you guys so much for coming, and I'll announce if I do this again or anything like that, any other future workshops. I do have a lot of other analysts part of the Discord. You've seen some of them. We have JTrade, we have Kang, we got Sunbeam, and each person, like me, my specialty is scalping day trades on the 1 minute, right? Kang, I believe he's really good at swings, and then JTrades, he's really good at order flow, and then Sunbeam is just good at everything. So I'm probably going to get some of them to do their own workshops in the future, so we'll let you guys know about that. And we probably will open it up to the public for the time being. Okay, well, thank you guys so much. I'm going to go ahead and log off. I have to get on the road tonight. I'm headed to San Antonio. I'll be logged in tomorrow, but it's going to be on the road. So I'm not going to be charting as much. I'm going to be on mobile. All right, guys, have a good night. I'm going to end stream now.